another year bites the dust, in the words of Freddie Mercury. And it's always good to reflect on tax time and what changes lie ahead. Just as a quick update, today the budget measures largely passed the Senate. So much of what you heard on budget night is now law. There's still a fair bit of work to be done on some of the mechanics. But be that as it may, thank you for joining us on this cold Sydney winter's evening. And we are just a week out from year end. So tonight, this is largely about you. I'm only going to say a few words just to summarise where we're up to. This is not as meaty a presentation as our budget night. And so we're really here to take some questions. Before we get started, just a little bit of housekeeping. We, of course, acknowledge the Camaragal people, the earliest recorded inhabitants of the land that today we call North Sydney. We do have a poll tonight. Quite often have a little poll to get some feedback on where you're at on the topic du jour, or de nuit, perhaps. And tonight I just want to know about how you did your tax return for 2025. And just tell us how you did it, whether you used a tax agent, whether you did it yourself, whether you filled out a paper form, or whether you still haven't got around to it. So that will make for some interesting discussions towards the end of the night. So without too much ado, let's fire up the slide deck. Then you can stop looking at me and look at the images. So given that it is only 7 days to the year end, there's not a lot of time to get stuff moving. So it's really a bit of a checklist to get your year end under control. So if we look at what's changed, so we know that in 2026, the lowest tax rate between 18,200 and 45,000 was 16%, and from 1 July this year, so the year starting next week, that lowest rate will drop to 15. Super guarantee started this year at 12% and continues into 2027. I think we've seen the last of those changes for some time. And the super concessional cap, super contribution caps didn't change in 2026, but they will change coming up. So 2026 compared to 2025, very few differences. But we will see a lot more changes coming into the tax year beginning next week. That's the 2027 year. Big news, bottom rate tax rate changes to 15% and will go to 14% next year. That is the year after, the 2028 year. Indexation is caught up on our superannuation contribution caps. So from next year, the concessional cap rises to 32,500, and the non-concessional cap, which is always 4 times the concessional cap, rises correspondingly to 130,000, and the total superannuation balance threshold rises to 2.1 million. So for many people looking at doing a bring forward strategy, waiting till the new year to exceed the 120 would make sense. So the important things that I'd like you to think about in the next week is to ask yourself, have I maximized my useful deductions? And we'll talk a little bit more about what they are. Have I reviewed my superannuation contributions? If you are thinking about changing them, check the cutoff date for your super fund. Many of them cut out earlier this week, so just double check. Look at whether you've got any capital gains that you need to deal with. Have you got all the records in one place? Grab that shoebox and collate it and keep it in one place. Scanning receipts is always a good habit to get into. And are there some superannuation caps I could or should use, and whether they're better off used next year? So I really want to talk about super opportunities, working out what income and deductions are relevant, talk a little bit about timing, and given the changes in the budget, which don't affect the 2027 year, they'll come into play in July 1, 2027, is some of the changes to capital gains tax and negative gearing. Talk about working from home and what that means, and the impact of the new $1,000 fixed deduction in the coming year, and just be clear what your end of financial year action plan is. So if you've got any questions, pop them in the chat. That's what tonight's all about. It's about getting your questions answered. So year end is always a great time to talk about getting your super up to speed, which means having a good handle on where you think your taxable income is going to land for the year. And for this year, that means you could put $30,000 concessional. That includes your employer contribution. You can do $120,000 non-concessional. And for those of you lucky enough to earn more than $250,000, you will need to pay an extra 15% on your contributions. Obviously, the most that could be is 15% of $30,000. So it's effectively a one-off lump sum. And remember, your carry forwards from 5 years ago will fall off. So anything you didn't use in the 2021 year will expire. So good time to review your super fund. So you can log into your fund portal and check that your employer contributions have gone in. That's a big change for next year. So come July, your employer contributions now have to be deposited within 7 days of payday. And so for those of you who are close to that 250,000 threshold, or your super contributions are close to 30,000, bear in mind that you will potentially get the June quarter. So the super that you effectively earned in April, May, June 2026 will turn up in July 26th in the next in the coming tax year, and you'll be getting your new contributions coming in on payday. So it is in theory possible that you could have 13 months contribution. So this will push some people over the limit. So definitely worth checking if you're doing some salary sacrifice. So check your salary sacrifice amounts, check that they did make it in the fund, check that they still make sense, review your carry forward caps, consider whether you want to make future contributions, and make sure you get the timing of that contribution right. As I said, many funds have already put the ruler under accepting contributions, but check with your fund. And the important point is they've got to be received by the fund by the 30th. So part 2 then is looking at income and deductions. So before you lodge your return, and this is partly why you shouldn't rush into doing it next week, make sure you're not leaving money on the table. So the first point is, well, what is your taxable income and what does that mean for your tax rate? Most of this stuff gets pre-filled. So if you're an employee, your employer will have been doing what's called single touch payroll every payday for the year. So within 14 days, so it's by about July the 14th, 15th, you should find that your tax ready payment summary, used to be called a group cert in the old days, will be available in your MyGov account, and it will be tagged as tax ready when it's been finalized for the year. If you've got any interest from bank accounts or you've had distributions from managed funds or ETFs, generally they will be pre-populated. Some of those won't be available till September, October, so you may have to do some of those manually if you want to get it in early. It generally won't pre-populate capital gains. Obviously, the tax office knows that you've sold your Bitcoin. It knows that you've sold some shares, but obviously it's not able to work out the tax for you. So you'll need to do that yourself. And that's where a tool like a wrap account or a ShareSite account or an Avexa account comes in very handy. And the ATO is watching. So we do have a self-assessment regime, but the ATO has a whole bunch of data matching systems that run. They know what you've got, and they will send you a please explain if it thinks you should have returned something that you haven't. The big areas of focus this year: work from home claims, rental property. Rental property is always a bit of an area of priority because there are so many errors on those returns. It would be a very happy hunting ground for the tax office to pull a random rental return. They would almost certainly find something on most people's returns. Side hustles, they do get data from Airtasker and Airbnb and Uber, so they know what you're doing. Crypto, they get returns from all of the exchanges. And so where you move between exchanges, they get a report. Which brings me to record keeping. The key thing in defending your return is, do you have the records? And the first piece of attention you're likely to get is a please explain going, we think you did X, why isn't it on your return? Or I see you've claimed X, what's it for? So having the right records is absolutely key to that. If you can't substantiate it, no deduction. But I do want you to focus on making sure that you do claim everything you're entitled to. And so the big one for most employers is work-related deductions, which includes your home office expenses, self-education, professional development, any registrations, union fees or memberships, vehicle and travel expenses, protective clothing, laundry and dry cleaning, tools and equipment, accountants or tax agents' fees, personal super contributions that you've lodged a notice of intent to claim for, investment income expenses like your ShareSite subscription, your financial advice fees, interest on margin loans, debt recycling interest, and of course your income protection insurance premium, because of course you all do have one, and to the extent that it's not paid from your super fund, you'll generally be entitled to a deduction, and your insurance company will send you a statement saying, here's how much you paid us, here's how much you can claim. And then of course donations, so a contribution to a deductible gift recipient is tax deductible. So make sure you've got all of that pulled together. Timing is critical. It's like doing your tax return is like comedy. Timing really matters. And so the general guidance here is to bring forward deductions either by prepaying. So you might want to prepay your interest. You might want to pay your car rego, whatever is deductible, this side of June 30 rather than next side. My car rego is due on the 7th of July, so I've always make sure I pay it by June 30. You can pay 13 months interest. You can pay 13 months insurance premiums. So all of those things can help bring forward a deduction. And just as you want to bring forward deductions, you want to push back income to the extent that you can. So, you might want to, instead of selling some shares next week, you might want to sell it the week after, or vice versa, depending on which way your tax rate's moving. And getting timing of those sales correct is important. But only do any of this that makes commercial sense. There is no point in spending $1 to save 32 cents in tax. These really want to be expenses you were going to pay anyway. It's just getting the timing of it right. So the big way of bringing forward expenses from next year into this year is prepaying your interest, prepaying insurance, bringing forward repairs. So if you've got something to do it this side of June 30 so that you get the tax deduction in this year rather than doing it on the first week of July when you have to wait a year to get the benefit of deduction. And of course, personal super contributions. Capital gains, very topical given the changes in the budget. And when we're having this discussion next year, the rules will be completely different for the 2027 year. So few traps. So got to look at, have you sold any investments? And when it comes to crypto, selling can mean more than you might think about it. So if you're receiving payments for mining or governance tokens or whatever, some of these may be taxable when you receive them. Look out for losses, making sure that you consume your losses as quickly as possible. Or if you've got some unrealized losses, it may be worth selling to realize those this year. And when it comes to share sales, the contract date's the relevant date, or the trade date, should I say, and making sure you consume your losses as quickly as possible. Now, you can't just sell and buy back the same thing. That's what's known as a wash sale. So the ATO is hot on that. So, but there's nothing to stop you, selling something that's at a loss. And many people will be sitting on some losses, particularly if you've got some, if you've been trading individual shares. There's quite a few shares that are down on the year. So making sure you consume those losses early is good. Know your dates. And of course, as I said, avoid wash sales. Oh, I think we talked about crypto, but one of the things that I'm very keen on here is that less tax is good tax when you're paying it, but what you don't want to do is let the tax tail wag the investment dogs. That a favorable tax treatment or a tax deduction will not turn a dud investment into a good investment. It's always nice to have, but we should never be making decisions purely because of the tax. So those of us who are old enough to remember the tax effective investment schemes in almonds and trees and sandalwood, more people lost money in those deals. And so, never do anything just because there's a tax deduction. Spending $1 to save 32 cents never makes sense. But you should be efficient in your taxes. And if you can do something that still makes sense to minimize the impact of tax, that's great. But you still got to be focused on the underlying fundamentals. Now, working from home, we're all doing it more, and our Those of you from Victoria now have the supposed right to work at home 2 days a week. I'm not quite sure what that actually means, but there's obviously some costs involved that you can claim on your tax return, but this is getting a lot of scrutiny from the tax office, so be very careful with this. So 2 main methods. The fixed rate method is 70 cents an hour, so you'll need diary records, and of course with toll tags and mobile phones, fudging where you were on the day is pretty difficult. And so you'll need a diary as to how many hours you work from home. It's simple, it's easy, just hours times 70 cents equals your claim. But the only records you need is how many hours you worked at home. If you work a consistent Monday and Friday at home, that makes life a lot easier, but you want to make sure that your diary records support that. And if you've got a meeting in the city in your diary, I wouldn't go claiming that day. Or if your toll tag recorded you being on the M2 at 10 a.m., be careful. The alternative for those of you with potentially larger claims is to look at the actual method, where you got to look at the individual costs. Lots of records, lots of calculations. There aren't that many people who will benefit from doing that, so work out why your expenses might be higher. If you've got a printer at home, you use lots of stuff, you use equipment that consumes a lot of electricity, they may be reasons. But for your average white-collar knowledge worker working from home, the fixed rate method will usually be simpler and easier. And so the 70 cents is designed to get electricity, phone, internet, stationery, and computer consumables. So that's SD cards, your mouse wears out, batteries for your mouse and keyboard, paper for your printer, ink for your printer. So all of those are not separately claimable, but they're designed to be taken into account by the 70 cents per hour. But there are still some things you can get extra. So your laptop and computer, to the extent that your employer is not providing it. Typically, these will be depreciated. Monitors, if you got 2-3 screens, office desk and chair, printers and equipment, and depreciation on those. If you do buy anything, make sure you keep the receipt. Big problem with these thermal printed receipts. They have a habit of fading over the time. So make sure you take a photo of it and save it, or scan it and save it somewhere. Many of the bigger retailers will now email you a receipt. So JB Hi-Fi, Officeworks will email you a receipt. Always a good option. And then understand whether you get an immediate deduction or depreciation for it. Generally, you don't get to deduct the occupancy costs of using your office. So these are things like mortgage interest, rent, rates, water, land tax, and insurance. There are some circumstances in which you can, but the 2 gateway tests for this to be available is, 1, your employer does not provide an alternative workplace, so you have no office to go to. This will be true for many BDMs and remote workers. And the area that you use is exclusively used for work purposes. So the studio that I'm coming to you from tonight is used exclusively for work. If you saw, there's not much room in here other than the equipment, so it's exclusively used. But bear in mind that claiming occupancy costs can affect your main residence CGT exemption. So there's a trade-off here, so be careful. What are the big mistakes that we see? The big one is stuff that you can substantiate. So if you don't have a document, be careful about claiming it. things that are of a private nature, daycare, food, etc. These are private expenses. Tax office not interested. Stuff that you've already been reimbursed for by your employer. So if your employer reimburses your phone cost, you can't go and claim it again. Kids' education or daycare or nanny, not deductible. Coffee, tea, milk, and general groceries. Obviously, these might have been provided for you in the office by your employer, but that doesn't make them deductible if you provide them to yourself at home. And of course, if your employer gives you the equipment, you don't get to deduct that either. Some of this might sound a bit obvious, but the ATO is making these points for a very good reason, and that is that it's obviously seeing these happen a lot. And at the risk of sounding like a broken record, records do matter. So keep your receipts, invoices, work from home diary or timesheets, and evidence of the hours you worked. So what should you do now, between now and next Tuesday, Wednesday? There's a handful of things you should do. Get a handle on your estimated taxable income. This is a number that you should probably have at your fingertips anyway. So, even if you haven't been doing it for this year, start next year going, where do I think I'm going to end up at the end of the year? So obviously your salary, very easy to predict for most people, be it commissions or bonuses, a reasonable estimate. You know what you've got over the last few years. So you should be able to take a fair stab at it. Dividends and interests, again, probably reasonably predictable from past history. Capital gains, bit harder. Make sure you got all your deductions lined up. Keep a track of your super. So it's always a good idea to log into your super account to make sure the contributions are coming in and they're being treated correctly. Don't get too obsessed about your balance. Looking at your balance frequently is a recipe for stress and heartache, but always good checking the transactions. Review your investments. Are they still making sense? Did that property purchase actually turn out the way you expected? Is the thesis that made you bought a particular share still true? Always good to keep reviewing it. Records. And of course, make an appointment with your tax preparer or accountant. And so that's really the sum total of the points I wanted to make.